Riding the market roller coaster, a look at recent volatility. Markets are always moving. Sometimes they go up and sometimes they go down. Lately we've seen some big swings in the market which can be scary. But it's important to remember that markets are always changing, and these ups and downs are normal. These changes happen for many reasons. Sometimes it's because of news about the economy, like when interest rates change. Other times it's because of global events like unexpected political changes or natural disasters. Whatever the reason, it's important to remember that market volatility is a natural part of investing. It's like riding a roller coaster. There will be ups and downs, but the important thing is to stay on for the whole ride. The Circle of Finance: Understanding Market Cycles. Just like the seasons change, markets also go through cycles. There are times of growth and prosperity followed by periods of decline and correction. These cycles are a natural part of the economic landscape. Throughout history we've seen many examples of market crashes and recoveries. The Great Depression in the 1930s and the 2008 financial crisis are two notable examples. While these events were undoubtedly painful, they also highlight the cyclical nature of markets. Understanding that markets move in cycles can help us better prepare for the inevitable downturns. It's not about predicting the future, but about recognizing that what goes down will eventually come back up. Liquidity, the fuel that ignites market recoveries. A key factor in market recoveries is something called liquidity. In simple terms, liquidity refers to the availability of money flowing through the system. When there's a lot of liquidity, it's easier for investors to buy and sell assets, which can push prices higher. Central banks like the Federal Reserve in the United States play a crucial role in influencing liquidity. They can inject money into the system by lowering interest rates or purchasing assets. This increased liquidity can act as a catalyst for market recoveries. When markets are flooded with cash, investors are more likely to put their money to work, driving up demand for stocks, bonds, and other assets. This increased demand can lead to a rebound in asset prices and a broader market recovery. Navigating the storm: staying calm. When markets are turbulent, it's easy to feel anxious when markets are volatile. Watching your investments decline in value can be stressful, but it's crucial to stay calm and avoid making rash decisions. One of the worst things you can do during a market downturn is to panic sell. When you sell investments out of fear, you lock in your losses and miss out on potential rebounds. Instead, try to focus on the long term and remember that market downturns are temporary. Staying informed is also essential. Keep up to date on market news and developments, but don't obsess over every headline. Remember, not all market fluctuations are created equal. Some are just noise, while others may signal more significant trends. Knowledge is power, making informed decisions in uncertain times. The key to navigating market turbulence is to approach it with a level head and a well-informed perspective. The more you understand about markets, the better equipped you'll be to weather the storms. Take the time to educate yourself about investing. There are countless resources available, from books and articles to online courses and workshops. Don't be afraid to ask questions and seek guidance from financial advisors or experienced investors. Remember, investing is a marathon, not a sprint. It's about making smart, informed decisions that align with your long-term financial goals. By focusing on education and rational decision-making, you can navigate market fluctuations with confidence. Weathering the storm and emerging stronger. Market turbulence is an inevitable part of the investing journey. It can be unsettling, even for seasoned investors, but it's important to remember that these periods of volatility are temporary. Just as a storm eventually gives way to sunshine, market downturns eventually give way to recoveries. By understanding the cyclical nature of markets, staying informed, and making rational decisions, you can weather the storms and emerge stronger on the other side. Remember, investing is a long-term game. Focus on your goals, stay disciplined, and don't let short-term market fluctuations derail you from achieving your financial aspirations.